So, hi everyone. My name is Ruca. I'm head of institutional for Karpatkey, and I'm going to make the case as to why institutions and enterprise companies should be adopting DeFi. So, let me start by uh, with a bit of information that shouldn't be news to you guys, which is, institutions have long been involved in invested in crypto assets, and first were the vehicles were used through VC funds and then eventually liquid funds. But in the beginning of this year, we really reached escape velocity with the launch of spot BTC ETFs and later the ETH ETFs, and that's when we started seeing real use adoption from these big guys. Um, Actually, their 13 Fs files show very interesting organizations. It's not that they're using and investing in spot BTC ETFs just because they believe in the long term value. Most of them are just hedge funds, hedging their positions on basis rate and whatnot. But what the important thing is that we're bringing net positive flows into the market. But actually, what happens when you start looking at the performance of these strategies is that the actively managed funds have actually outperformed basically spot BTC holdings, and there's different types of strategies that hedge funds have been using, ranging from multi-strat to quant and actively traded, and basically crypto non-directional strategies that have slightly outperformed throughout the last 4 years. But when you look from a volatility perspective, is when you actually start seeing that actively managed funds have really outperformed these guys, and we've seen drawdowns in the last 4 years that have reached the 75% mark in BTC holdings. Whereas for instance, in crypto non-directional holdings, we've seen much less volatility. So we really want to look at this from a lens of risk-adjusted returns, right? And when we plot the sharp ratios, in different time frames, we actually see that crypto non-directional strategies have really outperformed typical buy and hold of these crypto assets. So, and it's kind of intuitive to understand the reason why, right? Because it's a fairly volatile market, and there's a lot of opportunity for these guys to create these delta neutral strategies and extract value out of the inefficiencies and volatilities of the market. So essentially, what we think is that if these guys have outperformed and if they're fed themselves into volatility to produce higher alpha, there's no better market for them to achieve that than DeFi. And the reason for that is that we're talking a 24/7 global, programmable, and composable market that offers a range of opportunities for market neutral strategies. So you can either use it as liquid staking derivatives or restaking liquid tokens by re-hypothecating your liquid liquid tokens, and then you can either supply on money markets, or you can provide as liquidity on AMMs and even liquidity mining, right? All of these strategies, they're composable, right? So there's layers of composability that will allow you to have additional yields on top of your basic holdings, right? But the other interesting characteristic of this market is that because it's trustless, it means that anybody can create their own markets, right? So we're talking about a fairly fragmented liquidity, which is prone for arbitrage strategies and whatnot, right? And that's something that would take advantage of in the former years. Um, but up until a couple of years ago, in order for you to participate in those markets, you'd have to take the underlying volatility as a risk of exposure, right? Because if you wanna get into DeFi, you're basically taking a exposure to a digital asset, and that digital asset value floats obviously with respect to USD. But that's just not the case anymore, right? Because there are stable coins, right? And they've been growing up until to the right. They're somehow be unaffected by the market trends and the bear markets, right? And we're talking about the 175 billion dollar market that is growing. And it's fairly concentrated around two assets, being USDT and USDC. So there's a lot of network effects, obviously, involved in those markets. But far beyond this, they're liquid, right? So there's a lot of trading activity involved in these stable coins. Actually, they're surpassing typical digital native assets on public blockchains, being it Bitcoin, Ethereum, in other alt L1s and L2s, right? So it's not only, you're not only hedging your position against USD, but you can also be certain that there's enough liquidity for you to deploy at scale without facing the risk of having some price appreciation when you get into these strategies. And a simple way for an institution to create a strategy and extract, predictable yields on DeFi is a typical money market design, right? And we're talking about a variable rate strategy that you know varies according to supply and demand in terms of funds. And there's an LTV, so you can actually post collateral up until a specific point. There's different markets, right? So take for instance this example, the AVV3 USDC market, and you can actually predict what the interest rate will be according to the supply and demand for that specific money market. And actually, these rates they've outperformed the U.S. Fed funds rate historically, especially in the last year. Um, and the great thing about this is that they're expected to continue outperforming the U.S. Fed funds rate as it starts going down. Um, if the U.S. Fed funds rate goes down, it means that potentially institutions are going to rotate their portfolios into riskier assets, meaning digital assets as well. And then there's going to be demand for leverage again, which is going to make the interest rates go up, right? So we have in front of us a year or two of a very bullish scenario where we can expect these DeFi rates to outpace and outperform the US Fed funds rate, which creates a good environment for institutions and enterprise level companies to deploy capital. But there's two stories. There's two actually two variables for this potential for yield extraction. The first one, obviously, is the interest rates per se, but we need to make sure that there's enough capacity in these markets to be able to sustain rates, and at least at the level that institutions can access on the TradFi market through buying T-bills and whatnot, right? Because as we've seen in the previous slide, the bigger the supply, the bigger the availability of assets, the bigger the availability of assets in comparison with the demand, the lower the rates, and that's how this market is algorithmically adjust. So we have to make sure that not only from the supply side, but also from the demand side, we need to have we have the capacity to receive capital at scale in these markets. So we did some math with, and the good thing about DeFi is that data is all available on chain, right? It's just a matter of trading the data. So we did this, and Maker guys, please forget me about the inaccuracies, but we did a simple exercise by just looking at Maker's DSR and trying to calculate the capacity of the Maker DSR to be able to create or generate yields bigger than the US Fed funds rate throughout the last 18 months, right? So the way we did this is that we looked at the DAI supply throughout the 18 months, and then we saw the variation in the DSR balance, and we looked at the accounting data of the Maker protocol and their profit margin to check their interest rates and check their potential for the DSR rates to be able to generate the net zero profit margin. Obviously, this is just theoretical, because potentially what would happen if supply would increase was that the Maker governance would necessarily have to decrease the DSR rates. But just for the sake of the experiment, what we saw was that there's 1.3 billion in potential supply that's sitting on makers' DSR in deposits that we could be leveraging with institutional capital, right? So there is the potential for it to grow. By the way, the great spike that you guys see on the beginning of 2024 here is just because we basically took the annual revenues in that the Maker protocol captured in interest rates, and then we just divided on a daily basis, and hence the difference and the spike on at the beginning of 2024. But we can see that there is um, an inversely correlated relationship between the DSR rate and the capacity for additional supply. So there's still space, right? But this is on the supply side. Let's look at the demand and what are the bull cases as to why we foresee as to why we expect in the future that the demand will grow, and with the demand, the additional capacity on the supply side. So first and foremost, and I really love this chart on the left, um, it just becomes obvious that stable coins are the single most important way that U.S. government has to keep the dominance of the U.S. dollar as the world's reserve currency, right? And when we look at each one of these categories, it's inevitable to see that stable coins are pretty much an asset that is almost 100% denominated in USD. Um, so we actually expect this evidence to become a bull case as to why the U.S. government should uh, finally pass a stablecoin bill. And if that's the case, it really means that potentially any financial institution should be able to custody and issue stablecoins, and that would have a tremendous impact in terms of the total supply of stablecoins. On the other hand, um, there's an important piece of information which has to do with the uncorrelated effect of the different use cases, right? Because back in the day, stablecoins used to be used as a means for settlement of financial transactions on DeFi protocols, but it just happens so that right now the emerging markets are, extensively using those as a means to protect themselves from their local currency debasement. So it's exciting to see that it's taking. We're seeing new use cases, and most of them connected with real life use cases, such as paying for your expenses or making sure that you can save money in a currency that doesn't inflate at 50 or 100% on an annualized basis. On the other hand, um, we can look at tokenization as another bullish phenomenon. And you can see the charts, and we're basically deducted stablecoins, obviously market cap, because it's just on another level. This is just relatively experimental. We're talking about 12 billion in issued RWAs, and mostly T-bills and whatnot. We're seeing another novel use cases of different financial assets that are moving onto public blockchains. There's some bullish use cases around having TradFi companies finally experimenting with this. We acknowledge it's still early, but it's a good indicative that this presents a good opportunity for these types of categories to go up. What excites me the most is not necessarily that these guys are moving their financial assets on chain, because that's just the first part, right? Because then you have to integrate those in DeFi protocols to provide them utility, right? Because otherwise, why would anybody want to buy these tokens if they have access to them by logging on their brokerage account? So you have to provide additional layers of utility, and I think they're kind of connected with what I've tried to explain before around DeFi composability and the capacity for using standards such as ERC20 or ERC4626, a yield-bearing token standard, to be able to move these tokens and post them as collateral, for instance, and extract additional utility out of them, right? And in that regards, I think for me, the biggest piece of news is MakerDAO's announcement of the billion tokenized treasuries Grand Prix. And this is basically a tender that is overseeing the potential to onboard an additional 1 billion worth of RWAs onto the Maker protocol, now rebranded as Sky. And by doing this, you're basically tapping into immediate distribution, right? Because DAI is directly distributed into every single DeFi protocol that you can think of. So we potentially can bypass all of that, pains of adoption of having new and scattered digital assets. You're essentially concentrating all of that RWA potential into a single asset that is immediately integrated into DeFi protocol. So I think that's pretty interesting, and I'm super excited to see the outcome of this. So the way I like to think about DeFi, and I know it's still early days, but I really see DeFi as, or at least having the potential to become the first true global, open, and self-sovereign financial wholesale market, right? And what I mean by this is that if you look at what happened in DeFi in the first 4 years, we've seen, essentially the democratization of financial services. So potentially anybody in the world could access, markets that back in the day and still today are prohibited either for, either by regulation or jurisdictions or whatever. We've opened up the access, and by opening up the access and making it global, we're essentially improving liquidity and improving all of the metrics that that come with it. But the next way for me is about abstracting the complexities. It's about creating new distribution channels. It's about integrating DeFi into the products that we use on a daily basis, right? And I'm talking about not only retail services, but also corporate services. So let me tell you a single experience that I've had in the past week. I think it was the first expression of what I'm trying to portray here. There's a wallet called Zeal, which I've downloaded. And I created a new account using the passkeys, right? So it was the first time that I created a wallet actually without having to save the seed phrase, right? So in seconds, I essentially issued a wallet on Ethereum. And then I've connected my Gnosis Pay card. And Gnosis Pay card is a non-custodial card that's connected with Visa, essentially allowing me to spend my crypto where all the authorizations go through a smart contract held on an L2 on Gnosis chain. So I connected the card. It was fairly simple, just a couple taps. And then I was asked to deploy some XI, which is the DAI version on Gnosis chain, in my savings account. And what potentially happened on the background is that the wallet was essentially deploying my XI on Maker's DSR, yielding 7.5%, right? And then on top of that, I enabled the capacity for refilling the card, meaning that my payment card balance would be automatically replenished from my savings account as soon as its balance gone down past $500 or whatever, right? So essentially what I'm talking here is that it is the first time that we're enabling these types of use cases in ways that can actually surpass the Web2 experience, right? The neobank experience is the first time that I see, capital efficiency at the point where I'm able to basically abstract it from these complexities, and I'm actually using a crypto bank as I would use a neobank with further functionality. So that's what I mean by this, right? I mean, being the first time that retail can have access to the same markets that the financial institutions have, and that'll have potentially massive improvements in terms of the financial products that we might create in the future. On top of that, these governance protocols, have been governed by decentralized organizations and themselves, and I think that's kind of connected with what karpatkey is trying to push, and I'll later explain what we've been doing, but they're professionalizing themselves, right? They're reorganizing themselves in ways that can prove that they're becoming efficient, that prove that they have underlying business models that are very, very profitable, right? And that can only add resiliency to the protocol themselves. And I've always been, vocal about the importance of these DeFi protocols to be able to be self-sovereign and be able to coexist in ways that provide resiliency. And that's what we're seeing here on these charts, and it's super exciting. So, how is it that Karpatkey will, offer exposure to the DeFi yields, actually? So let me start by explaining what Karpatkey is in the first place. So Karpatkey is the leading on-chain asset manager. We're managing roughly 2.6 billion worth of DAO treasures for the leading DeFi DAOs out there. We're talking about Gnosis, we're talking about Aave, Balancer, we're talking about DYDX, whatever. So yeah, we've actually been working hands in hands with the DeFi protocols, not only helping them find ways to use their treasuries in productive ways, ones which could support their business use cases, not only from a diversification perspective, but also from a perspective of using capital to be able to support their use cases and to bootstrap their DeFi markets, right? But then we expanded the range of service to provide anything finance related, right? So we've been doing accounting, we've been doing budgeting, we've been doing capital raises, we've been doing debt structuring, we've been doing M&A, essentially helping these DeFi protocols to organize themselves in ways that are much more efficient than they used to be before. On top of that, we actively participate in their decision-making processes, right? We're big delegates for a bunch of these guys. And this actually means that we know what's happening. We can actually influence the product development of these protocols. So we understand the mechanics of these protocols and the way they interact with each other. And we've been using their treasuries to be able to allocate on one another and create like this cohesive block of DeFi protocols that are going to last, hopefully, a lot of decades. So the way we've been doing this is by using on-chain infrastructure, obviously, because DAOs live on-chain. So what we do is that we manage the treasury portfolios that are deployed on a safe multi-sig, right? And then we implement a set of access control on-chain smart contracts that allow us to have granular access, third-party access to these safes, meaning that we manage them even though we don't own the assets. We have direct access and the capacity to execute upon a set of pre-approved policies, right? And the on-chain permission policies, they're very, very granular in the way that we can structure them. So for instance, we can be allowed to deploy or to supply on a money market, in a specific set of assets under a very specific set of constraints, not parameterized. So not only talking about amounts, but also slippage and any type of parameter. So they can be very granular, and we use our trading desk to do so. But we can also, and most interestingly, we can set automations around these policies, right? So, for instance, we can act because we have direct access to the assets. We can create automations that allows us to react according to market volatility events or to prevent liquidations on leverage positions. So we've been doing a lot of interesting stuff around automations on behalf of these DAOs, and this is the way that we are able to protect the treasuries of the DAOs that we're managing. So up until now, we've been managing these DAO treasuries, and again, through saves with Zodiac roles modifier, which are the on-chain permissions policies. And we use all of the data and execution and risk management infrastructure that has been developed throughout the 4 years of existence. No lost funds, more than 9K transactions executed. We're obviously developing a lot of the operational skills in order for us to be able to execute without any potential risk, even from inside. Now, what we're about to do is that we're leveraging this same technology to be able to provide institutional access to DeFi yields. And what I mean by this is that on top of this Zodiac plus Safe, we're going to develop a tokenized fund, right, that is going to issue shares that represent a percentage of the underlying portfolios, and we're going to build a legal wrapper on top of it, a regulated fund established on Cayman that is going to provide institutional access to these portfolios, right? So what we mean to do here is essentially taking what we've learned from the on-chain space and really adapting to the existing reality to be able to offer access to these yields in a way that's controlled, that's compliant with the institution's jurisdictions. We're starting by interacting with the lowest hanging fruit, and what I mean by this is digital native enterprises like exchanges and fintech that already are nimble from a technical perspective, but they're also nimble from a regulatory perspective. So the first implementation of these funds are actually going to be plugged into exchanges as form of an earn account, right? So, for instance, on the first fund that we're going to launch, a USD stable yield fund, it's fairly simple, low risk stuff. It's just denominated in USDC and deployed on the blue chip DeFi money markets. And we're going to plug those into earn accounts on exchanges and offering exchanges users the possibility to deposit their USDC balances into a very, very simple set of strategies of which, value proposition is to outperform the US Fed funds rate, right? So as you've seen previously on that DeFi yields rates chart that I've pulled off a couple of slides ago, they're variable rates, right? So there's moments in time where DeFi rates, they actually exceed the US Fed funds rate, but there's moments where that's not the case and then the spread reverts, right? So what we're going to do to be able to guarantee at least the US Fed funds rate is that we're going to rotate the portfolio onto RWA tokens, right? That represent T-bills. And that's the reason why we're basically locking the downside and, creating an upside for yield exposure on DeFi protocols. So this is the USD stable yield fund. Then, this is, relatively low risk stuff. Then if you want to go a little bit more degen, we're going to use a different set of stable coins, more exotic assets deployed on protocols that we know and that we interact with on a daily basis. But, you're basically going down the risk curve. And then because of that, the expected return is a little bit higher. And then the third fund that we're going to launch, and it's directly connected with the information that I provided around the capacity of these DeFi DAOs underlying businesses to grow and to generate future cash flows. Is a DeFi Alliance Fund. And the DeFi Alliance Fund is a basket of DeFi native tokens that represent the leaders in each DeFi category, being it AMMs, money markets, and derivatives or whatever. And we're going to hedge that position against ETH to be able to reduce a little bit of the vol. But we're super excited with this product. And yeah, basically, that's it. I'll leave it up for questions if you have some. Thank you.
Just how do you, thank you. How do you think about asset liability management when it comes to allocating, MakerDAO or your client's assets?
Yeah, so we obviously place a lot of importance on the risk management side, as I've mentioned before. We contribute directly to these protocols, right? And some of the proposals that come up onto governance forums, they're actually written by our team. So we really understand what types of collateral are used in Maker, for instance, to issue DAI. So we have the means to be able to monitor that collateral type and that exposure to different assets in ways that really prevent us to have some kind of exposure. So that's the stuff that we've been doing for the last 4 years or so. Yeah, it's complex, right? That's the reason why we charge management fees, because it entails an entire risk management team that is constantly monitoring the markets and understanding where the risks may come. Thank you so much.